Welcome to Growth TV. I'm Carolyn Vallejo, and we're here for a quarterly update once again with Scott Linch, the National Industry Leader of Private Equity at FORVIS, and Bob Dunn, Managing Director of GF Data. They're here to share some insights on what the Q1 data means for the deal-making environment going forward. Scott and Bob, welcome back.
Thanks for having us, Carolyn.
So in the first quarter, we saw middle market PE-backed deal volume begin to rebound. Can you talk a little bit about what's behind that trend and what that means for the year going forward? Scott?
Yeah, well, I think that it's just a little bit of a broken record on some of the things, some of the trends of what we've seen over the last few quarters, because we keep thinking we're going to see this pop. And we did see a little bit of a pop from a count standpoint, deal count. So that's encouraging that we're seeing people start to do deals. And we did see the deal dollar value still decline a little bit, but which means people are kind of getting okay with what the valuations are and doing deals anyhow. But we're still seeing other things like growth equity, where people are writing smaller checks so they can still invest in businesses. We're seeing an increase in the continuation fund momentum, and so we even saw a big exit coming out of a continuation fund in the first quarter, which was the SRS distribution deal, which was a pretty large deal to Home Depot. And so was an encouraging sign that we're seeing that continuation fund model work. And but I think that this back half of the year, we're just going to continue to see even more activity. I mean, we're seeing the amount of deals where our investment bank specifically working with owner operators, those owners are ready to sell their businesses. They've been waiting. And so there's a ton of deal flow coming out of that community. Private equity is still kind of holding on to their businesses a little bit, and that's why they're using the continuation funds, but owner operators and entrepreneurs are really looking to start to exit. So we think that the deal volume in the back half of the year will really pick up.
Yeah, I would agree with everything Scott said. It's not a deluge of deals happening, but it's definitely more momentum than we saw through the last 3 quarters. Starting to get back to what we saw in 2022, which I think is a reasonable target in terms of number of deals per quarter. The valuations have slipped a bit. I actually view it as a positive sign that the sellers are starting to accept that it's not 2021 anymore, and that they're not going to get the valuation they necessarily want on it. As we've hit on before, almost a majority of deals with either earn-outs or seller financings. Again, sort of whatever mechanism they can get to bridge that, buyer's perspective on value versus seller's perspective on value.
Mm-hmm. Got it. So interestingly enough, the above average financial performers didn't have such a great first quarter. Can you talk a little bit about why that is?
Yeah, so just to give background on, we break out into a category of above average financial performers. You have at least 10% trailing 12-month EBITDA margin, 10% trailing 12-month revenue growth. Somewhat arbitrary metric, but it's what we use on it. You saw in 2022 and most of 2023 a lot of activity from above average performers. They represented the majority of the marketplace. We've actually seen that trend reverse now in the first quarter. Only about 38% of deals were above average, and only about a 12% premium from everyone else in the market for those above average transactions. Again, I look at that, more people are coming into the pool. You're getting a broader array of companies out there. It's not just the A companies that are transacting, which I think, again, that coupled with deal volume and the sort of reconciliation in purchase prices is positive signs that you're going to have more activity out there.
Yeah, I think it's just the reconciliations of buyers and sellers a little bit there is what's happening. We're seeing just overall lower valuations to get deals done.
Mm-hmm. Got it. Now let's break it down by industry. What types of industries are really getting deals done, and what are we seeing there in terms of valuation?
Well, so it's interesting on it, and I think Scott and I were talking before this, business services is still very, very hot. We saw a slight decline in valuation in the first quarter on it. I think some of that is just systemic. There's been a lot of activity in business services, and I think, some questions developing around, sustainability of earnings in those businesses. I don't think it's a big issue on it. We saw improvement in retail, which I thought was interesting. That's a sector that was very hard hit post-COVID. I don't know if that's going to be a sustained improvement, but definitely some improving pricings on it. And then manufacturing, still solid, but down off its historical average. So I think, again, a market that's trying to rebound, I think, on it, but definitely some downward pressure on valuations.
Yeah, I think that we're still seeing the healthcare and technology deals are slightly down. Healthcare has been really tough lately. I was talking to some folks earlier about what the FTC non-compete is going to do, and it's really big in healthcare. For instance, like if you're doing a healthcare deal, a big thing is the non-competes with the doctors to lock up one of those deals. And without non-competes, it could be a little challenging for getting those deals done to figure out how to structure it so you still have some sort of non-compete, because you want to maintain those doctors and not let them go somewhere else. So that's going to be an interesting sector to watch. We're definitely still seeing anything that has a subscriber base or, some sort of recurring revenue continue to be hot. I mean, anything around the home is still very hot. And I mean, we're seeing roofing is a big one now. We're seeing pool services. So anything that helps, and HVAC deals are just continuing to be very hot. So that sector, and like you said, the business services, I think that's again a lot of this recurring revenue model. Something where you have subscribers and you're valuing those businesses oftentimes on a revenue multiple, sometimes versus an EBITDA. So.
Excellent. All right. So some interesting things happening that could impact the quarters ahead. And as always, we will check back in next quarter. But in the meantime, thank you both for joining us again on Growth TV.
Thank you.
Thanks for having us.